Today we will look at power stocks, but beyond the usual power generation companies. You see, we've been underestimating India's power revolution. It is about much more than just renewable energy plants. This transformation has 5 facets and each is a game changer for many stocks. Increased renewable energy capacity is only one of those 5, but for most of us, we've only focused on companies that generate more power. Grid modernization will enhance the efficiency and reliability of electricity supply. Energy storage solutions facilitate better load management and allow for round-the-clock power supply. Decentralized energy generation to empower consumers and make this man's bill zero. And electrification of transportation, which drives entirely new business models in the power sector. Starting with the increased renewable energy capacity, we all know that India is investing heavily to reach 500 gigawatt of renewable power by 2030, which is double the current capacity. This massive expansion directly benefits stocks from 2 segments: green energy generators and equipment manufacturing companies, or EPCs. For EPC companies, the first stock to watch is Waaree Energies Limited, primarily for solar module and cell manufacturing. Waaree was awarded the manufacturing capacity under the Tranche 2 of the PLI scheme for high efficiency solar PV modules. This is a 19,500 crore program aimed at building domestic solar module manufacturing capacity and reducing import dependence. This grant provides substantial financial incentives on a per unit basis for manufacturing and selling domestically made modules over 5 years, significantly improving profit margins compared to open market sales. The PLI award supports Waaree's investment in establishing large-scale technologically advanced manufacturing capacity, which should solidify its market leadership. Waaree's introduction of the Waaree Radiance all-in-one solar kit also directly targets the retail boom in rooftop solar projects by simplifying adoption and improving distribution reach. Finally, the biggest missing link in India's solar supply chain is the manufacturing of ingots and wafers, which are the raw material for cells. Waaree is also investing heavily to set up ingot and wafer manufacturing facilities. The next stock from the same space is Borosil Renewables, which is set to benefit profoundly not just as a supplier, but as a protected core manufacturer of a critical input. Its deep benefit stems from the fact that it is the only domestic manufacturer of a component that is essential for every photovoltaic module. Solar glass has historically suffered from extreme dumping by heavily subsidized Chinese manufacturers, which eroded Borosil's margins. However, the recent imposition of an anti-dumping duty and the establishment of a reference price on imports acts as a crucial barrier to the entry of cheap foreign glass. This effectively ensures a minimum profitable selling price for Borosil's domestic output. The company has also undertaken ambitious expansion plans to increase its solar glass manufacturing capacity to 10 gigawatt of solar modules by 2026. For power production companies, we can choose literally any, but 2 stand out for me. Adani Green Energy Limited for its aggressive scale and vertical integration. It leverages the Adani Group's expertise in transmission and solar or wind manufacturing to execute massive integrated renewable parks. Focused on becoming a global leader in installed capacity, AGEL's diverse portfolio includes solar, wind and hybrid projects. As the renewable market evolves, there is potential for cross-sector synergies and enhanced energy reliability. This diversification allows AGEL to adapt to the changing market conditions and technological enhancements, ensuring sustained growth. As of 2023, AGEL aimed to reach 25 gigawatt of renewable energy capacity by 2025 and over 50 gigawatt by 2030. If the company continues to successfully execute its projects pipeline, this capacity goal could position it among the largest renewable energy producers not just in India but in the world. Tata Power Company Limited is also in the same group for its diversification and B2C focus. It has an excellent mix of utility scale projects but with strong penetration in high growth segments like rooftop solar and the EV charging network. More on these 2 segments a little later, since Tata Power is developing a very unique niche with more potential arguably than all the other stocks combined. But building power capacity is pointless if our transmission wastes half that power. India's power grid and transmission system are set to pivot from a legacy system designed for centralized coal plants to a flexible, resilient network built to integrate large volumes of variable renewable energy. This transition is often referred to as no transition without transmission. This would happen in 3 parallel avenues. Interstate transmission capacity boost, where the Central Electricity Authority projects that peak power demand will reach approximately 446 gigawatt by 2035, necessitating significant expansion from the current capacity of 241 gigawatts. The transmission network is expected to grow substantially from 485,000 circuit kilometers in 2024 to an estimated 650,000 circuit kilometers by 2032. The investments potentially exceed 13 trillion rupees. The second transformation would be high voltage direct current adoption. HVDC technology will become mainstream for long distance, high capacity bulk power transfer, especially from large solar and wind parks. See, most of India's transmission is still HVAC or high voltage alternating current. HVDC, on the other hand, offers lower transmission losses and better grid stability than HVAC. This improvement is critical for the ongoing green energy corridor, which focuses on evacuating power from designated renewable zones with minimal transmission losses. The third major change is inter-regional connectivity. The inter-regional power transfer capacity will be significantly enhanced to ensure that the surplus power in one region, for example the solar-rich South or West India, can be reliably sent to deficit regions, for example during peak demand in the north, especially in summer. Three stocks stand to benefit the most from these transformations. Siemens Energy India Limited for its high-tech equipment monopoly, a leading player in manufacturing and supplying high-voltage equipment, especially for HVDC systems. See, HVDC VSC systems are used to convert AC current to DC current, so it has to play a major role in India's transmission transition, as we just spoke about. These products are critical for evacuating bulk power with low losses. Analysts forecast a revenue CAGR of 30% and a PAT CAGR of 41% over the next 3 years, with power transmission segment growing by about 43% CAGR. The strong order book of 162 billion rupees also provides excellent revenue visibility for the medium term. Power Grid Corporation of India is next as the dominant player responsible for the execution and ownership of the interstate transmission network. It is the primary beneficiary of the green energy corridor capex. As a regulated entity, its earnings are also stable and linked to its regulated asset base, which is growing significantly. A regulated asset base is basically the company's projects, including earnings and investments, that are directly under the supervision of the government. Analysts project steady growth for the revenue CAGR of 5.5% and an EPS CAGR of 8.7% with a return of equity of 16.6% in 3 years. That sounds low, but remember it's a PSU, so a 16.6% ROE on a PSU would be excellent. Hitachi Energy India is next for HVDC and grid automation. It specializes in power quality and high-tech solutions like HVDC transformers and FACTS, which are flexible AC transmission systems, to ensure grid reliability among varied renewable energy supply. Now, variable renewable energy supply refers to the natural highs and lows of power supply from renewable energy sources like solar and wind. Hitachi Energy is well positioned to capture contracts for complex grid stability solutions and technology upgrades in this rapidly modernizing transmission and distribution sector in India. For smart grids, the distribution segment will undergo a massive digital overhaul to reduce aggregate technical and commercial losses, AT&C losses. This would work in 3 parallel avenues. Smart metering rollout, where the government's revamped distribution scheme mandates the widespread deployment of prepaid smart meters across the country, targeting millions of installations. This is the foundation of the smart grid, enabling real-time billing, remote connect or disconnect, and dynamic pricing. The second is two-way flow management. The grid must adapt to a two-way power flow to handle distributed generation from millions of residential and commercial solar rooftop projects. See, currently, our systems are equipped to send energy only in one direction, from power plants to consumers. But as rooftop solar becomes more commonplace, we will need a way to evacuate excess energy from these so-called prosumers, which are consumers who also produce electricity. This requires advanced SCADA and ADMS softwares at the distribution level. Finally, we have predictive maintenance. New technologies like AI, machine learning, and drones will be integrated for asset management, monitoring line health and predicting equipment failures. This should significantly reduce downtime and improve grid resilience. Yes, that's how modern India's power sector is trying to become. AI in power. Genus Power Infrastructures Limited is our pure-play smart meter supplier. It is a major supplier of smart meters to utilities, benefiting directly from large tender wins under the RDSS. The company operates both manufacturing and service segments. Reported PAT CAGR of 76% over the last 3 years reflects the accelerating order inflow from smart meter tenders. High visibility, driven by the target of installing 250 million prepaid smart meters across India, makes this perhaps the safest small cap to buy into. HPL Electric and Power Limited finds its footing in integrated metering and electricals, a manufacturer of smart meters, switchgear and lighting solutions. This benefits from the broad T&D modernization and increased demand for prepaid meters. It reported a PAT CAGR of 127% over the last 3 years. The company's large order book and diversified product range places it as a key supplier across the distribution value chain, especially since it directly benefits from the reduced aggregate technical and commercial or AT&C losses for discoms. Larsen & Toubro Systems for the integration and EPC is also a key player. While not a pure-play manufacturer, L&T's electrical and automation division and its T&D EPC arm are crucial for the large-scale system integration, software and project execution required for smart grid implementation and substation automation. It benefits from the higher margin and complex systems integration part of the smart grid rollout, leveraging its strong relationship with state discoms and central utilities. But the transmission systems cannot handle all the renewable energy generated. Since the supply of power from solar and wind projects are inherently unpredictable, storage is essential for providing grid balancing and round-the-clock power. India has a target of integrating 411 gigawatt-hour of storage by 2032. Exide Industries or Amara batteries are the best domestic BESS manufacturing place. These companies are establishing large-scale lithium-ion gigafactories under the PLI scheme for advanced chemistry cells. This capacity will primarily feed the exploding EV market, but will also supply grid-scale battery energy storage systems solutions. The India BESS market is expected to grow at a CAGR of 27% from the value of 250 million in 2024 to 1.2 billion by 2030. These domestic players are positioned to dominate local supply, benefiting from falling battery costs and government incentives like the 3,670 crore viability gap funding for 4 gigawatt-hour BESS projects. Tata Power Company is the largest integrated storage developer. It is actively developing massive pump storage hydro projects in Maharashtra, for example the 1800 megawatt project in Shirata, and integrating BESS into its renewable projects to deliver round-the-clock power. Tata Power's PSH strategy and its in-house battery manufacturing by the name Agratas give it a cost and supply chain advantage in securing profitable renewable energy plus storage tenders over the next 5 to 7 years. Finally, NHPC Limited or SJVN as again PSH developers. As major hydropower PSUs, they are uniquely positioned to develop the bulk of the required pump storage hydro capacity, which by the way is the cheapest option for multi-hour and multi-day storage. These are direct beneficiaries of the massive government push for PSH, with large project pipelines already being sanctioned to meet the 27 gigawatt PSH target by 2032, up from only about 5 gigawatt right now. But perhaps one of the greatest innovations in India's power sector is decentralized energy generation. Specifically, through decentralized renewable energy, this refers to the small-scale power generation systems located near the point of consumption. These operate completely independent of the main central grid. Under the Muft Bijli Yojana, India is targeting 1 crore households with rooftop solar, which is the largest form of DRE. This will turn millions of consumers into prosumers, producers and consumers of power, making DRE a major component of the national energy mix. That is also how this man can get his electricity for free. Eligible households can receive up to 300 units of free electricity every month through their installed solar panels. The scheme also offers substantial subsidies covering a large portion of the initial installation costs, which is why the deployment of solar mini grids is expected to sharply accelerate. These projects bring 24/7 high-quality power to clusters of villages, enabling uplifting economic activity like cold storage and digital education. Tata Power's integrated rooftop ecosystem is India's largest integrated utility with a strong B2C brand presence. It benefits through its subsidiary, Tata Power Solar, which manufactures panels and provides EPC services for rooftop and ground-mounted projects. Its vast network, financing options, and integration with EV charging gives it a massive advantage in the retail DRE space. The company's rooftop solar division is a primary focus area, driven by government subsidies. Analysts project its renewable energy portfolio, including DRE, will drive the revenue CAGR of 15 to 20% over the next 3 to 5 years. KPI Green Energy's captive power focus specializes in developing and maintaining solar projects for the commercial and industrial segment under the captive power producer model. This is a crucial area of DRE where large businesses install solar to drastically cut power costs. The company's business model, build, own, operate, transfer, or boot, provides a stable recurring revenue as well. It has reported strong historical growth, with its PAT CAGR exceeding 50% over the last few years, indicating high profitability from the commercial and industrial DRE boom. Basically, KPI is to businesses what Tata Power is to an average consumer. Finally, all the electricity India produces must be met by rising demand, and that is where electrification of transportation comes in. Electrification of transportation in India is the process of replacing vehicles powered by internal combustion engines with electric vehicles. vehicles. This transition involves not just manufacturing EVs but also building the necessary charging and battery supply infrastructure. The stocks poised to benefit most are those that have committed massive capital under the government's production-linked incentive for EVs and advanced chemistry cells. Ashok, Leyland and Olectra Green Tech engage in electric commercial vehicles and electric buses, both of which are now mainstream thanks to multiple schemes by the government. Tata Power is a dominant charging network operator with the largest integrated utility actively deploying EV charging infrastructure under the brand Easy Charge. It aims to install 100,000 charging stations just by the end of this year. Its EV charging business recorded strong momentum in Q1 FY26, driven by network expansion and high utilization. As a regulated utility, its charging business provides a stable long-term revenue stream critical for the entire EV ecosystem. NTPC Limited, the largest power generator in India, is also actively establishing charging power stations at its power plant sites and key locations nationwide. NTPC's charging business also aims to integrate renewable energy sources into this infrastructure. Its deep pockets and national scale position it to be a key provider of charging as a service, especially for public transport fleets. Thank you for watching the video. Until next time.